Hello, this is the Business Strategy Game Report for Team E, EpiX Performance in Industry 3. My name is Tanya Cooper and I'm joined by my teammates JD, Cassandra, and Selena. Our strategic vision was to stand for something bigger than sneakers. We want our customers to be fearlessly driven and believe that shoes elevate the sport and change the game. We also made sure that we stood by our vision of doing what was right by people in the world. So to do this, we wanted to create a premium product that used high quality materials. We also made sure that our employees were trained in quality, and we made small investments in corporate responsibility programs. So at the start of the game in year 11, we noticed that there was much industry consolidation. In order to create that premium brand, we knew that we must make moves to differentiate our brand. We chose to have a high SQ rating and a product line with a high number of models with room to grow. Initially, Group D chose a strategy that set itself apart from the group, as they chose to have a high price, high SQ, but a low number of models. So ours was a premium brand strategy, and to execute this strategy, we invested heavily in brand advertising, retailer support, and internet marketing to promote the premium brand. We used a large percentage of superior materials and invested in enhanced styling features and TCM quality programs. In years 12 and 13, we had the largest marketing expenses compared with other teams, and we were the first brand to arrive at a 100 image rating by year 13, where we remained through year 17. We felt that celebrity endorsements were important at the beginning to establish the brand, but we tapered those off in subsequent years. Models gradually increased from 350 to 500, and we had a higher average star rating than the industry. By years 13 and 14, we were at our best years, and our results put us in our desired strategic quadrant. We had an 8.4 SQ rating for internet and wholesale markets, and we were the highest priced of all competitors with an above average number of models. By year 14, we noticed that F and G were starting to gain market share, and F was moving into our desired market quadrant. To prevent losing any share to F, we chose to lower our price and to remain competitive and try to capture some share from G. We reduced our models to help contain costs, and we started to pattern many decisions after competitor G. It was in year 15 that we started making adjustments based on competitors and ultimately landed us in a similar spot as G. F ended up in our desired competitive space, but their market share moved to our company and G. And as demand declined, we made small adjustments in SQ and price to remain competitive. So by the end of the game, the industry was segmented into two categories, low-end models or high models. And our attempt to compete with market leader G resulted in similar placement.
Hi, my name is Selena Samaniego, and I will be reviewing the net revenue, earnings per share, and stock price performance for EpiX Performance. Between year 10 and year 13, we saw steady growth in our revenue. Our strategy was focused differentiation with a high SQ rating and a high model availability in order to appeal to the higher end consumer. During these years, we significantly increased our internet and wholesale price, which affected our net revenues in a positive manner. In year 14 and year 15, we saw slight growth as competition began to increase. During these years, we shifted our strategy to be more price competitive and conscientious of our competitors to compete for market share, which we believe affected our net revenue to slow its growth. In year 16 and year 17, we saw consistent and steady growth as we had worked in prior years to expand capacity. We maintained pricing from previous years along with increased demand for our product, which aided in the steady growth of our net revenues. Between year 10 and year 11, we focused on high quality and high pricing, setting ourselves apart quickly from competitors and doubling our profit, which aided in doubling our earnings per share. We saw a slight decrease in year 12 with our EPS, which we attribute to facility expansion efforts, increase in retailer support expenses, increase in stock sold, and a slight decrease in profit. Year 13 through year 16, we saw steady growth with our earnings per share. During these years, we began to buy back stock and continue to increase our profit. And in year 17, we had strong growth with our earnings per share with high net revenues and overall company profit. For our stock price, from year 10 to year 11, we saw significant growth due to our high pricing of our product and greater demand of our product compared to competitors. In year 12, we did see a slight decrease in stock price due to our investment efforts, stock sales, and a slight decrease in product. However, year 13 through 17, we see steady growth in our stock price as we continue efforts for higher prices, increased demand, and increased profit.
This is JD Garza, and I'm going to be talking about competitor strategy, specifically as it relates to our main rival, which we deem to be Team G or Team Goliath. As Tanya pointed out previously, there was a small cluster group initially of teams that were right in the center of the competitive or comparative group mapping. And we really wanted to try and break away into that upper right quadrant, which was more about premium pricing, greater SQR, and more models being produced. So we had early success. We were the first team to $1 billion in sales. We were the first team with a 100 rating image, and we were doing really well. And unfortunately, in year 14, we decided to scale back a little bit on those spending areas in terms of brand advertising and retailer support in particular, which was to our detriment and to the gain of Team G and some of the other teams. We lost some retailer outlets while they gained quite a bit. And so we really lost that competitive advantage we had in the early years. And they also had a strong focus in increasing their SQR throughout the sequential years, which led to increased market share. There was a strong and positive correlation for them as they committed to that. And then the other thing they did a really good job of was their pricing strategy. Initially, they started out at parity pricing and even above parity pricing in the first few years, but then started dropping their price to industry and then below industry, if you will, in the latter years as demand dropped, as the industry growth dropped. So I think they were able to capitalize on that, not only versus our team, but the other teams as well, in terms of the significant increase in sales that they had. Third, they also did a really good job of expansion as it relates to their production facilities, their investment in Latin America, their warehousing in terms of the amount of shoes that they could then take on. They did a good job of increasing that incrementally throughout the years and also gained a significant advantage over not only our team, but the other teams as well. And I think that led to their operating costs being better, their operating margins being better, and that led to overall operational efficiency that we didn't realize and some of the other teams didn't realize to their degree. And I think that helped, their overall cash position or financial position, if you will. Specifically, it helped them, gain better performance in earnings per share, return on equity. And the most amazing thing was that they weren't even taking out big loans to fund all these improvements, enhancements, spending and advertising. So that is something we're still scratching our head about, but they really did a good job overall with that financial performance based on those strategies and tactics that they utilized. Our 3-year strategic plan outlook starting with year 18 was really going to be focused on getting back to doing those things that were really helping drive some early success. First and foremost, our premium pricing that was really affording us some nice sales revenue and net income performances. So the first thing we're going to do out of the box in year 18 is get that pricing back up to attain that premium and luxury brand status. And then also we want to really get back to our commitments that we had initially that was really driving our success, which was our spending in brand advertising, retailer support, 100% for sure, and celebrity appeal. We saw what happened when we scaled back, and we saw what happened when other teams increased their spending in those particular areas. So out of the box, we would really be focused on those two things to get our positioning back up. Not only from a competitive standpoint, but also from a profitability standpoint as well. In year 19, as I spoke about previously, some of the other teams did a great job, like Team F, Team G, and Team I, of expanding into Latin America and expanding their production and warehousing. And saw some great benefits in operating margins that I think we needed to be more cognizant of at the time. And so we would definitely have a strong focus in those particular areas. And then also, we think we can do a better job with our overall operational efficiency, much like I talked about with Team G. I think that's what really helped them from a financial performance standpoint. So we definitely want to see if we can't make improvements in that area as well. As we look to year 20, we had to take out some loans in year 16 and 17 of significant amounts. So we would hope that we would be in a position to reduce some of those long-term liabilities and loans, which would then help us from financial performance and metric standpoint if we're able to pay some of those off. And if that was the case and we had enough cash on hand or cash available, we would definitely want to initiate a stock buyback initiative, which also would help from a ROE standpoint and an overall financial position standpoint. The other thing we would want to focus on is to try and find that sweet spot in terms of the number of models that we would produce. We went from 300 to 350, 400 to 450, and then 450 to 500 in sequential years. And we saw some good results, some good incremental revenues. But we were going to try and hone in on that, number that's really optimal as it relates to production costs. As we produce more number of shoes, our rejection rates were going up, obviously, which was quite costly as well. So we would definitely want to try and hone in on finding the right amount of models that we would produce to stay competitive. And then finally, looking into year 20, we would obviously want to try and meet investor expectations, as it relates to the key performance and financial metrics, but also try and eyeball above industry performance as well, given that some of the other teams were able to have some really high stock prices, some really high return on equity and earnings per share. So we would definitely try and position ourselves to whatever degree possible that we can meet or perform above some of those levels.
Hello, my name is Cassandra Holcomb, and I'll be discussing our wholesale, internet, and private label market strategies, as well as going over the lessons learned. Our wholesale market strategy was really geared towards securing and holding as much of the market share as possible. We were targeting a very aggressive goal to hold 20% of the market, and we were confident that our increased marketing efforts and higher quality would drive those numbers. In years 11 through 13, we did see a steady increase, but we fell flat and even dropped a little bit by year 16. By year 17, we finished transitioning to a 2-week lead time in all regions and had established our marketing and distribution well enough to allow us to hit that 20% market share in all areas except for Asia Pacific, where price competition was still incredibly fierce. Our internet market strategy was similar to our wholesale strategy, in which we wanted to secure and maintain 20% of the market. We kept our internet pricing 40% above wholesale price to avoid dissuading the wholesalers away from our product. We increased our internet advertising year over year, and gradually transitioned to offer free shipping in each of the 4 markets. As you can see in the graph, we had increased in market share through year 12, but experienced fluctuations in year 13 through 15 as we tried to dial in the optimal price points to drive an acceptable operating profit margin without driving away demand. For the private label segment, we really just wanted to maintain a presence in that market. Anytime we found ourselves with excess production capacity, we would filter it to private labels. We had a strong start in year 11 and struggled a little bit in years 12 and 13, where we discovered that our pricing was a little bit too high and we were losing contracts. By year 14, we had dialed in the pricing strategy and distribution strategies to allow us to sell most, if not all, of our available inventory in the private label segment each year. By year 17, we didn't have enough production capacity remaining to supply each region, so we decided to pull out of Asia Pacific for the year and supply the markets that had the highest potential operating profit margins. The main lessons learned through playing the BSG were the competitive assumptions, understanding that they were an industry average for the previous decision year. As a team, we were pretty passive. In hindsight, we should have adjusted the competitive assumptions to be more aggressive so that we could have remained on par with G and F as they increased spending. Celebrity appeal is something that really took us by surprise. We had good appeal ratings in year 12 and 13, but the bids became so high that we pulled out of the celebrity bidding completely into year 16. After analyzing G and F and trying to determine what was really differentiating them, one thing that stood out was that they had a significantly higher consumer appeal rating, and that helped them pull ahead of us as the game progressed. If we were to play the final 3 decisions, we would have increased our spending to secure more celebrity appeal. We also failed to scale our operations. Based on the market share we were targeting, we did not build up the manufacturing capacity to support it. So in hindsight, we should have issued more stock early in the game to increase capital and use that capital to purchase more manufacturing space. This also would have given our company more assets and helped drive up our ROE, which we struggled with in the middle of the game. Finally, as a team, we decided to take a late game strategy adjustment where we shifted slightly away from the premium brands. This unfortunately paved a clear path for F and allowed them to leapfrog ahead of us. And then we also had to learn firsthand how difficult it was to start competing with G, who was already well established in their targeted market segment. On behalf of EpiX Performance, my co-managers and I would like to thank you for your time.